Welcome to the deep dive. Today we're jumping into something really fundamental, how public money gets managed and accounted for right here in Nepal.
Exactly. It's crucial for understanding how the whole system works, really.
And we're going to ground this discussion by looking at concepts that, have actually appeared in past CAPE 3 exams.
That's right. So definitely valuable if you're studying for those exams. But honestly, even if you're just interested in governance or economics in Nepal, you'll get a lot out of this.
Right. Our mission today is to really unpack the core ideas behind public financial management, PFM, and the Nepal Public Sector Accounting Standards, or NPSAS.
We'll look at key definitions, the processes involved, the reforms that have been happening, and of course, some of the challenges too.
Okay, let's dive straight in with NPSAS. There's this term, government business enterprise. It pops up quite a bit. What exactly makes something a government business enterprise?
Okay, so based on our source material, a government business enterprise has a few defining characteristics. First off, it needs the legal power to actually make contracts on its own.
So it can act independently in that sense.
Yes. And second, it has to have both the financial and operational authority to run a business. And importantly, it sells goods or services as part of its regular activity.
Aiming for profit, or at least covering costs.
Precisely. Making a profit or achieving full cost recovery. And here's a really crucial bit. It's generally not reliant on ongoing government funding just to keep operating.
Ah, okay. Except maybe for standard purchases.
Exactly. Unless the government is buying from it at arm's length, basically, a fair market transaction. And the final condition is that it has to be controlled by a public sector entity.
That independence from continuous funding seems like a major differentiator.
It really is, especially, in Nepal, where there's always discussion about state-owned enterprises and their financial health. This definition helps clarify whether they're, well, truly business-like or more dependent.
That clarifies things nicely. Okay, moving on within NPSAS, the cash basis of accounting. Sounds simple, but what are the important details?
Well, on the surface, it is quite straightforward. Cash basis accounting means you only record transactions when cash physically comes in or goes out.
So it's all about tracking the actual money flow.
Pretty much. The focus is squarely on cash inflows, outflows, and the resulting cash balances. It gives you a clear picture of where the cash came from, how it was spent, and what's left.
Very direct.
Very direct. But it's important to remember, while the main statements focus on cash, the notes section often includes extra info about things like liabilities or maybe some non-cash assets.
Ah, so the notes provide more context.
Exactly. The core is cash movement, but the notes fill out the picture. It's simple, which can be a big plus for tracking public money accountability.
Simplicity definitely has its advantages in large organizations.
Yeah.
Now, what about cash equivalents? We hear that term a lot in finance. How does NPSAS define it?
Right. Under NTSAS, cash equivalents are things like short-term, highly liquid investments. The key things are highly liquid, easy to convert to a known amount of cash, and they have an insignificant risk of changing in value.
So things that are almost as good as cash.
Exactly. Think very short-term government bills or maybe some money market accounts, things where the value is stable and you can access the cash quickly. Like short-term treasury bills from Nepal Rashtra Bank could be an example.
Got it. Not long-term stuff that might fluctuate wildly. Okay, next up, cash controlled by the reporting entity. This feels fundamental. What determines if the government actually controls cash for reporting?
Control is absolutely central, yes. An entity is seen as controlling cash if it has the power to use that cash for its own goals or benefit.
Power to use it
And crucially, the power to stop others from accessing or using that cash. It's really about who has the authority to decide how the money is spent.
Okay, clear principle. How does that play out with different government funds and accounts?
Well, cash an entity collects itself, or money that's specifically allocated, appropriated to it that's clearly under its control. It can use that for operations, buying assets, paying debts.
Makes sense. And money in its bank accounts.
Same thing. Funds in the entity's own bank account are considered controlled by them.
What if the government collects money, but it's actually for someone else?
Good question. If an entity collects cash on behalf of, say, another government body, it might sit in their account briefly before being transferred to the main government fund, the Consolidated Revenue Fund, or wherever it's meant to go.
So control is temporary in that case.
Exactly. The collecting entity only controls it while it's physically in their account before the transfer. Then control shifts to the entity that ultimately gets the funds.
Okay, that clarifies that specific situation. What about the Treasury Single Account, or TSA? How does that fit in?
Cash moving through or held in the TSA is reported in the cash statements of the relevant entity. Sometimes you have a central treasury function managing accounts and making payments for different departments.
Right, like a central payment hub.
Sort of. Those transactions are treated like internal account changes. Think of it like a bank handling payments for its clients. Even though it's centralized operationally, the control over the funds still rests with the individual department the money belongs to.
Interesting. So it boils down to who has the ultimate authority, even if the mechanics are centralized, and transactions administered for others. Can they be reported differently?
Yes, in some specific cases, cash receipts and payments can be reported on a net basis, showing the net effect rather than the full inflow and outflow.
When would that apply?
It's an exception, really. It typically applies when the entity is just acting as an administrator or agent for someone else without much say in how the funds are used.
Got it. Focusing on the economic reality, who benefits and controls. Let's shift gears slightly to receipts of external assistance. Nepal gets quite a bit of this. What key terms should we know here?
Understanding the terms is definitely important. External assistance itself is broad. It covers all official resources Nepal can use for its objectives. Think loans, grants, technical help, guarantees, anything under a binding agreement.
And where does this assistance come from?
It comes from multilateral external assistance agencies, like the World Bank or ADB, set up by international treaties, and bilateral external assistance agencies, which are agencies of other individual countries providing aid.
What about NGOs? They play a big role too.
Right. Non-governmental organizations, or NGOs, whether foreign or local, are set up independently from government to provide assistance. It's important to distinguish their aid from official government-to-government or multilateral aid.
Our materials also mention official resources and assigned external assistance.
Official resources is basically that broad category of aid from multilateral, bilateral agencies or other governments we just talked about. Assigned external assistance is when one entity gets aid but then passes it on or assigns it to another entity to use.
Like a ministry getting a grant and giving it to a specific department to implement the project.
Exactly like that. And then there's relent external assistance loans.
Sounds like a loan being passed along.
Precisely. The government receives an external loan and then lends those funds out again to another entity within the country, maybe a public corporation or a specific body.
This breakdown really helps clarify the different funding streams. Okay, let's tackle something potentially trickier. Determining whether control exists for financial reporting purposes, especially when it's not obvious. This links to consolidation, right?
Absolutely. Public entities often set up other bodies to achieve policy goals. Whether the main entity needs to include these others in its consolidated reports depends entirely on whether it controls them.
So how is control determined in these cases?
The guidance looks at specific power and benefit conditions. Generally, control is presumed if the entity meets at least one power condition and at least one benefit condition, unless there's clear evidence another entity is actually in control.
Okay, what are some examples of these power conditions?
Power conditions could be things like owning, directly or indirectly, a majority of the voting rights in the other entity, or having the legal power to appoint or remove most of the governing body members.
So having the dominant say in decisions.
Essentially, yes. Or the power to cast the majority of votes at meetings.
And the benefit conditions, what do they involve?
Benefit conditions are about being able to get the economic benefits or having to bear the economic burdens of the other entity, like having the power to dissolve it and get most of its remaining assets.
Or being responsible for its debts.
Exactly. Or being liable for its obligations, or having the power to direct it to distribute its assets to you.
That seems fairly clear when those majority conditions are met. But what if they aren't?
That's where power indicators and benefit indicators come in. These are factors that, even without majority ownership, can suggest control exists.
Okay, like what kind of indicator?
Power indicators might include having the power to veto budgets or overrule the governing body's decisions or approving key personnel appointments.
Anything else?
Yes, also, if the other entity's mandate is set and limited by specific legislation originating from the controlling entity, or holding something called a golden share.
A golden share. What's that?
It's a special kind of share that gives the holder specific veto rights or control over key policies, even without owning a majority of the regular shares.
And the benefit indicators in these non-majority situations.
Benefit indicators could be things like holding title to the other entity's net assets with ongoing access rights, or having the right to a big chunk of its assets if it's liquidated.
So it's about who ultimately gains or loses financially.
Pretty much. Or being able to direct the entity to cooperate towards your own goals, or being exposed to its leftover liabilities. It's about the substance of the relationship.
That detailed look at indicators is really helpful for those gray areas. Let's shift to something practical, but unfortunately necessary. Correction of errors. How does NPSAS say these should be handled?
Right, errors happen. If a significant error related to a past cash balance is found, NPSAS says you need to correct it by adjusting the opening cash balance of the current period.
So you fix the starting point for the current year.
Exactly. And importantly, you should also restate the comparative figures from those prior periods to reflect the correction. That is, unless it's genuinely impractical to do so.
And transparency is key here, I assume.
Absolutely. You have to disclose the nature of the error in the notes, the amount of the correction, and state whether the comparative info was restated or why it wasn't, if that's the case.
What kinds of errors are we talking about?
Oh, it could be calculation mistakes, applying policies incorrectly, fraud, simple oversights, things like that. And restating might even mean amending previously approved financial statements, though local laws might affect that.
Okay, so identify, correct the past figures presented, and be upfront about it. Seems vital for trust. Now let's talk about the qualitative characteristics of financial reporting. What makes financial info genuinely useful?
Good question. For financial statements to be useful, regardless of the accounting basis, they need certain qualities. The main ones are understandability, relevance, reliability, and comparability.
Let's break those down. Understandability.
It means the information should be clear and concise enough for users who have, a reasonable grasp of public sector stuff and accounting and are willing to actually study the info, avoid excessive jargon, present it logically.
Makes sense. Keep it accessible.
Right.
What about relevance?
Information is relevant if it can actually influence users' decisions, maybe by helping them evaluate past or future events or by confirming or correcting their previous assessments. And for info to be relevant, it also needs to be timely. Old news isn't usually relevant.
And materiality often comes up alongside relevance.
Yes, they're closely linked. Materiality means information is significant if leaving it out or misstating it could reasonably influence a user's decision based on those statements. It depends on both the nature and the size of the item.
Okay, then reliability. What does that entail?
Reliable information needs to be free from significant error and bias. Users should be able to depend on it to faithfully represent what it claims to represent. Reliability includes several subcharacteristics, like faithful representation, substance over form, and neutrality.
Tell us more about faithful representation and substance over form.
Faithful representation means you account for things based on their economic reality, their substance, not just their legal form. For example, a lease might legally be a rental, but if it effectively transfers ownership risks and rewards, its substance might be closer to a purchase. Substance over form is the principle emphasizing that economic reality.
And neutrality.
Neutrality means the information is free from bias. Financial statements shouldn't be slanted to influence a decision in a particular way or achieve some preset outcome. It needs to be objective.
Then there's prudence. What's that about?
Prudence is about exercising caution when making judgments or estimates, especially when there's uncertainty. It means you don't overstate assets or revenues, and you don't understate liabilities or expenses. Being realistic, basically.
Okay, and completeness.
Completeness means the information should include everything necessary for users to understand what's being reported, within the limits of materiality and cost. You need to include all the important stuff.
But cost is a factor.
Yes, there's a balance. The benefit users get from information should ideally outweigh the cost of providing it. That leads into the constraints.
And finally, comparability. Why is that important?
Comparability lets users see similarities and differences, either between different entities' reports or the same entity's reports over time. To achieve this, you need consistent accounting policies and you need to present prior period info.
You mentioned constraints on these characteristics.
Right. There are practical limits. The main one is the balance between benefit and cost providing info costs time and money. Is the benefit worth it? Sometimes it's hard to quantify.
And balancing the characteristics themselves.
Exactly. Sometimes making information more relevant might make it slightly less reliable, or vice versa. Achieving the right balance often requires professional judgment from the people preparing the statements.
This framework of qualities is really helpful for understanding what good public financial reporting looks like. Let's circle back to external assistance received. We define the types, but what are the specific disclosure requirements under NPSAS?
NPSAS wants transparency here. First, the total cash amount of external assistance received during the year must be shown separately right on the face of the statement of cash receipts and payments.
What about aid that doesn't come as direct cash to the government, like when a donor pays a supplier directly?
Good point. Assistance where third parties pay directly to settle government obligations or buy things on its behalf also needs separate disclosure.
How should that be broken down?
You need to distinguish between payments made by third parties that are part of the same overall government economic entity and those made by external third parties. But importantly, you only disclose these if the entity has been formally told about the payment or has verified it independently.
Right, you need confirmation it actually happened.
Yeah.
What about showing who the providers are?
If you get aid from several providers, the significant classes of providers should be disclosed separately, either on the face of the statement or in the notes.
And distinguishing loans from grants.
Yes, if you receive both, the total amount received as loans and the total as grants should also be shown separately, again, either on the statement face or in the notes. This detail helps track who's giving support and what kind it is.
That level of detail definitely supports accountability. Okay, let's look at the comparison of budget and actual amounts. How does NPSAS require this comparison to be presented?
This is a core requirement. NPSAS says any comparison of budget and actual figures must be presented on a basis comparable to the budget itself. Meaning you have to use the same accounting basis, the same classification methods for both the budget numbers and the actual results. It has to cover the same entities and the same time period, apples to apples.
So you might need to adjust the presentation format.
Exactly. You might need to present the comparison differently than the original budget document to ensure comparability. Financial statements might consolidate entities that had separate budgets, so those budgets might need recompiling for the comparison.
And you can't just change the budget figures afterwards to match what was spent.
Absolutely not. The comparison is always against the approved budget. Any revisions made to the budget during the year also need to be shown and explained separately.
That's crucial for accountability. The sources mentioned budget and financial statement accounting bases can differ. How's that handled?
Yes, that happens. A budget might use, say, a modified cash basis with some commitments included, while the NPSS statements are pure cash basis. Or the budget might only cover the core government, while statements consolidate public enterprises too.
Or different levels of government.
Right. Statistical models might define sectors differently. If the national government controls subnational levels, it consolidates them. Otherwise, they report separately. When these differences in basis or scope exist, the notes must clearly explain them so users understand the comparison.
Transparency about the differences is key. Let's talk about the financial statements themselves under NPSAS. What are the required components?
An entity following NPSAS must prepare 3 core components. First, the statement of cash receipts and payments. This shows all the cash inflows, outflows, and balances controlled by the entity. It also has to separately identify payments made by third parties on the entity's behalf.
Okay, that's the main cash flow statement. What else?
Second is the accounting policies and explanatory notes. These provide the crucial context how the statements were prepared, the specific policies used for significant transactions, and any extra info needed for a fair presentation that isn't on the statement face.
And the third component?
The third is the comparison of the approved budget and actual amounts. This can be a whole separate statement, or it can be presented as a budget column right within the statement of cash receipts and payments.
So those 3 together give the full picture. Let's zoom in on the information in this statement of cash receipts and payments. What specific numbers must be shown?
Okay, the statement must show the total cash receipts for the period, broken down into relevant subclassifications based on the entity's operations where the money came from.
And payments.
Similarly, the total cash payments for the period, again with appropriate subclassifications showing the main areas of spending. And finally, it needs to show the cash balance at the beginning of the period and the cash balance at the end.
How detailed do those subclassifications need to be?
Detailed enough to fairly present the cash flows, letting users understand the main sources and uses of cash. The general rule is gross reporting.
Gross reporting, meaning?
Meaning you show the full amount of each inflow and outflow. You don't net receipts against payments for the same type of activity, generally.
Are there exceptions to that gross reporting rule?
Yes, a couple of main ones where net reporting is allowed. First, For transactions, the entity just administers for others, like collecting certain taxes for another agency. Second, for items with quick turnover, large amounts, and short maturities, maybe certain short-term investments.
Okay.
And the statement should also use line items, headings, and subtotals where needed to make the presentation clear and understandable.
So aim for full transparency with gross figures, but allow netting in specific limited cases. The standard also talks about reporting on a net basis more generally. It seems like it's not the preferred approach.
That's right. Gross reporting is definitely preferred in the statement of cash receipts and payments for transparency. The exceptions are specific.
Like those agency rules.
Exactly.
Ah.
Governments often act as agents collecting taxes, holding deposits, transferring funds, managing expenditures through a single account. But even then, net reporting is only allowed under those specific conditions we mentioned, usually when they're just an intermediary.
Got it. Transparency first. What about payments by third parties on behalf of the entity? We mentioned this with external aid, but does it apply more broadly?
Yes, the disclosure rules apply generally. An entity needs to disclose the total payments made by another entity that's part of the same economic group, broken down by source and use.
And payments by completely external parties?
Those also need to be disclosed. But again, only if the reporting entity has been formally advised or has independently verified the payment occurred during the period. It ensures all significant cash flows benefiting the entity are captured, even if the cash didn't pass through its own accounts.
Reinforces that focus on economic substance. Let's talk about the structure of the notes. How should they be organized?
The notes are absolutely critical. NPSAS recommends a systematic structure. First, they should lay out the basis of preparation confirming compliance with cash basis NPSAS and explain the significant accounting policies applied.
So how the numbers were put together.
Exactly. Second, they provide all the additional information needed for a fair presentation that isn't on the face of the statements. This could be more detail on specific lines, explanations of big transactions, disclosures about commitments or contingencies,
How should they be presented?
logically and understandably. And importantly, each item on the main statements should be cross-referenced to any related info in the notes. This helps users navigate and get the full story.
Notes are the bridge between numbers and context. What about the reporting period? Is it always annual?
Yes, NPSS requires annual presentation, usually aligned with the government's fiscal year. If, in rare cases, the reporting date changes, making the period longer or shorter than a year, specific disclosures are needed.
Like what?
You have to explain why the period isn't a year and state clearly that the comparative figures might not be directly comparable because of the different period lengths. Consistency is really important for comparing over time.
Makes sense for trend analysis. The standard also covers restrictions on cash balances and access to borrowings. What needs disclosure here?
Entities need to disclose in the notes any significant cash balances that aren't actually available for them to use immediately.
Why might cash be unavailable?
Could be due to legal or contractual restrictions, or restrictions imposed externally by donors or lenders. The nature and amount of these restricted balances must be disclosed.
What about borrowing potential?
Yes, they also need to disclose any undrawn borrowing facilities available for future operations or capital spending, along with any significant restrictions on using those facilities. It gives a fuller picture of liquidity, not just cash on hand, but potential access to.
So it's about available resources and constraints. Consistency of presentation is another key principle. What does NPSA say?
It emphasizes keeping the presentation and classification of items the same from one period to the next. This helps comparability.
Are changes ever allowed?
Yes, but only if there's a good reason. Maybe a significant change in operations, or if a review shows a different presentation would be more appropriate and reliable. Or, of course, if a future NPSAS update requires a change.
And if a change is made?
It has to be disclosed clearly, and usually the comparative figures for the prior period should be restated to match the new presentation, unless that's impractical.
Consistency aids comparison. What about the requirement for comparative information itself? What needs to be shown from prior periods?
NPSAS generally requires comparative figures for all numerical information in the current statements. So, for every number this year, total receipts, payments, balances, you show the number from last year too.
Why is that important?
It lets users see trends, see if things have improved or worsened. It provides context. This doesn't apply in the very first year NPSIS is adopted, though, and comparative narrative info in the notes should also be included where relevant.
Seeing the previous year's numbers is essential context. Okay, identification of financial statements seems basic, but why the specific requirement?
It might seem obvious, but it's crucial to clearly distinguish the official financial statements from other info that might be in, say, an annual report. NPSA only applies to the statements themselves.
So clear labeling is needed.
Exactly. Each component, the cash statement, the notes, the budget comparison must be clearly identified, and key info needs to be prominent on each page. The entity's name, whether it's individual or consolidated statements, the reporting date or period, the currency used, and the level of precision, like thousands or millions of rupees. It avoids confusion.
Clear labeling prevents ambiguity. Now let's tackle consolidation procedures and disclosures. We know when it's needed, control, but what are the mechanics and disclosure requirements?
When preparing consolidated statements for the whole economic entity, the controller, and its controlled entities, several steps are needed. First, you eliminate all cash balances and transactions between entities within the group, intra-entity stuff.
To avoid double counting.
Precisely. If entities have different reporting dates, you might need adjustments to align them, ideally within a 3-month difference. And you must use uniform accounting policies for similar transactions across the whole group.
What if different policies were used?
Then you need to disclose the proportion of items in the consolidated statements affected by those different policies.
What else needs disclosure about the group?
You need to list all significant control entities included in the consolidation, their names, where they operate. And importantly, if any controlled entities are not being consolidated, you must explain why in the notes. Transparency about the scope is vital.
Understanding who's in and who's out is definitely important. Let's move to foreign currency treatment. Given Nepal's international links, how is this handled?
It's very relevant. If an entity has cash transactions in foreign currencies, these need to be translated into the presentation currency, usually Nepalese rupees, using the exchange rate at the time of the transaction.
What about foreign currency held at year-end?
Those balances are translated using the exchange rate prevailing at the reporting date, the closing rate.
And if consolidating a foreign-controlled entity?
Their cash receipts and payments are translated using the exchange rates that existed when those transactions occurred. Importantly, the entity must disclose the total amount of exchange differences that arose during the period due to rate fluctuations.
And if the presentation currency itself changes?
The reasons for changing the presentation currency must be clearly explained in the notes.
So translate everything and disclose the impact of rate changes. Okay, what about changes in accounting policies of superseded cash basis NPSAS adopters? This sounds like a transition issue for entities moving to the current standard.
Yes, exactly. For entities that were on an older version of cash basis NPSAS, there are rules for adopting the current one. Generally, they should retrospectively adjust the opening cash balance and restate prior period comparatives as if the new policy had always been used.
Always retrospectively.
That's the preference. But if determining the past effect is truly impracticable, then they apply the new policy prospectively just going forward.
And disclosures.
In all cases, the effects of the change must be recognized and disclosed. If retrospective application wasn't possible, they need to explain why, state the nature of the change, and the amount of adjustment made in the current period.
Prefer retrospective for consistency, but allow perspective with explanation if needed. Let's look closer now at the presentation of a comparison of budget and actual amounts.
Right, we know it's mandatory. Entities must present this comparison publicly for the budget they're held accountable for. It needs to show the original approved budget, the final budget, if revised, and the actual amounts on a comparable basis.
And explain differences.
Yes, any material differences between the budget and actuals must be explained. This explanation can be in the notes or in another public document issued alongside the statements, as long as there's a clear cross-reference in the notes. It ensures deviations are flagged.
What about explaining changes from original to final budget? Budgets often get revised. How's that handled?
NPSAS requires an explanation of why the budget changed from original to final. Was it just reallocating funds within the existing totals, or due to other significant factors like policy changes or revenue forecast adjustments?
Where's this explained?
Again, either in the notes or in a separate report issued around the same time with a cross-reference in the notes. It helps users understand the context of the final budget numbers being compared.
Understanding budget shifts is important context. Briefly, what about multi-year budgets? NPSAS is annual, but planning is often longer term.
True. Many governments use multi-year budgets, which are essentially a series of annual targets reflecting longer-term policies. Some systems even allow rolling forward unused appropriations.
How does that fit with the annual comparison?
The way original and final budgets are determined within that multi-year framework can vary. Sometimes judgment might be needed to define the original and final for a specific year. The annual NPSAS comparison is basically a snapshot within that broader multi-year plan.
A snapshot within a longer view. What specific note disclosures of budgetary basis, period, and scope are needed to make the annual comparison meaningful?
To ensure the comparison is understandable, the notes must explain the budgetary basis and classification basis used in the approved budget. We talked about how these might differ from the NPSAS cash basis and classifications.
Right, explaining the differences.
Exactly. Also, disclose the period covered by the budget. Is it just annual or part of a multi-year plan? And finally, identify the specific entities included in the budget scope. This is crucial for consolidated statements to ensure the budget scope is reasonably comparable to the actual consolidated results.
Transparency on the budget framework is essential. The standard also mentions reconciliation of actual amounts. Is a formal reconciliation always required between budget basis actuals and statement actuals?
Not explicitly mandated for every single difference. However, NPSAS strongly encourages a reconciliation if the budget and financial statements aren't prepared on a fully comparable basis due to differences in basis, timing, or entities covered.
Why is it encouraged?
Because it helps bridge the gap. A reconciliation explaining the major differences improves transparency and accountability. It helps users understand why the budget plan and the actual results might look different. Good practice, even if not strictly required for every detail.
Explaining major differences aids accountability. Let's move to joint arrangements, common in the public sector, right? How does NPSS view them?
Very common entities collaborating on projects or services, usually formalized in an agreement. Under cash basis NPSAS, the main focus is just reporting the entity's own cash receipts and payments related to its involvement.
So just tracking its own cash flow related to the arrangement.
Primarily, yes. The standard doesn't go deep into accounting for joint arrangements itself. However, it does encourage entities to disclose significant joint arrangements in the notes, maybe list them and describe their interest.
Any other guidance?
It notes that other IPSAS standards dealing with financial instruments and joint arrangements, IPSAS 35, 36, 37, can offer relevant concepts, especially around defining control, which helps determine the nature of the involvement, joint operation versus joint venture, etc.
So cash flow focus, but disclose the arrangement and consider control concepts. Lastly, for NPSAS, what about financial reporting in hyperinflationary economies and restatement?
This is for extreme situations. If an economy has hyperinflation, think cumulative inflation around 100% over 3 years, NPSAS encourages restatement of financial statements. Because rapid currency devaluation makes comparisons over time misleading, people start thinking in terms of more stable currencies or non-monetary assets. The standard suggests restating everything into the currency's value at the end of the reporting period using a general price index.
And comparatives.
Comparatives from previous periods should also be restated using the same index to maintain comparability. Not a recent issue for Nepal, but an important principle in international standards.
Good to know about that contingency. Okay, to wrap up our NPSA section, can you give us a quick overall summary of what NPSS is all about?
Sure. NPSAS, the Nepal Public Sector Accounting Standards, were developed by Nepal's Accounting Standards Board Public Sector Committee. They're largely based on the Cash Basis International Public Sector Accounting Standards, IPSS.
When did they come in?
They became effective from early 2009. The main goal was to standardize financial reporting for public entities in Nepal, aiming to boost both the quality and the comparability of that reporting.
And the structure, Part 1 and Part 2.
Right. Part 1 contains the mandatory requirements for cash basis reporting. Definitions, disclosures, specific issues entities must follow. Part 1 to claim NPSAS compliance. Part 2 is non-mandatory. It suggests additional disclosures and policies entities are encouraged to adopt to further enhance their reporting and transparency.
Excellent summary. That gives us a solid grasp of NPSAS. Now, let's broaden our view to public financial management, PFM, and government accounting in Nepal more generally. Our sources outline key dimensions and a cycle. Can you walk us through that framework?
Certainly. PFM is basically the whole system, laws, rules, processes governments use to get money, revenue, decide how to spend it, allocate, actually spend it, account for it, and then audit the results.
What are the main dimensions?
There are 3 broad dimensions. First, mobilizing revenue and managing other resources. Second, managing public debt. And third, managing public spending and ensuring accountability for it.
And these operate within a cycle?
Yes, a continuous 6-phase PFM cycle. It starts with budget formulation and program development, then comes budget implementation.
followed by
public procurement and accounting for all the transactions, then information and reporting systems. After that, internal control and internal audit, and finally, external audit.
Could you briefly touch on what each phase involves?
Sure. Budget formulation is the planning stage, figuring out resource needs and spending plans for the year linked to policies. Implementation is putting the budget into action, releasing funds, carrying out activities.
Procurement and accounting.
Procurement is buying goods and services. Accounting is recording all the financial transactions properly. Information and reporting is about providing timely data for decisions and tracking performance.
And the controls?
Internal control and audit are the government's own checks to safeguard funds and ensure processes work. External audit is the independent review, like by the Office of the Auditor General, OAG, checking everything afterwards.
A continuous loop from planning to independent review. What are the big picture objectives of having a strong PFM system?
A good PFM system aims for four main things. First, overall fiscal discipline, keeping spending and revenue in line with targets, sustainable borrowing.
Okay, fiscal stability. What else?
Second, strategic resource allocation, making sure money goes to the government's actual priorities, allocative efficiency. Third, operational efficiency, getting the best value for money in delivering services.
Value for money, right? And the fourth?
And finally, promoting accountability and transparency, clear processes, accessible information, oversight, democratic checks. Though achieving perfect fiscal discipline, for instance, has been a historical challenge in Nepal with budget execution issues. Understanding that tension is important.
Those objectives seem fundamental. How does the PFM system actually work in Nepal? Who are the key players?
Nepal has a history of economic planning. Key players include the Ministry of Finance, MOF, at the federal level, and similar bodies provincially. There's the National Planning Commission, NPC, for development plans.
And the spending agencies.
Yes, the various ministries and departments that actually spend the money. Then you have the Financial Controller General Office, FCGO, crucial for government accounting and reporting, the Office of the Auditor General, OAG, for external audits.
And the legislatures.
Yeah, absolutely. The federal parliament, provincial assemblies, local assemblies, they provide the crucial legislative oversight of the whole process.
So what does the process look like in practice, from planning through oversight?
It generally starts with the NPC developing multi-year plans, though coordinating these across the new federal levels, federal, provincial, local, has been, a bit of a challenge.
Policy and budget.
Policy is set by legislatures, sometimes with local input. Budget prep happens at all three levels, following guidelines, though delays can occur. Implementation also faces challenges, sometimes late spending, centralized approvals for some things.
Accounting and audit.
Accounting is mainly FCGO's job, preparing consolidated federal statements on a cash basis using NPSAS. Audit is the OAG, reporting to the president, and reports then go to parliamentary committees for review. Public procurement has its own oversight body, the PPMO.
Are there key dates to keep in mind?
Yes, the Constitution mandates the federal budget presentation around just the 15th, and the OAG typically submits its annual audit report by the end of Chaitra.
A complex network indeed. Let's focus on the role of the Auditor General in PFM. What's the AG's specific contribution?
The AG plays a really critical role. They evaluate PFM system risks through independent audits. Their job includes checking if spending was proper and regular, but also evaluating the 3 E's: economy, efficiency, and effectiveness.
So not just ticking boxes, but looking at value for money.
Exactly. They might also look at the skill and rationality behind spending decisions. They provide assurance to Parliament and the public through valuations, policy reviews from a financial angle, and compliance checks.
Is the audit function itself under review?
Yes, there's ongoing recognition of the need to strengthen public auditing in Nepal, things like better quality control, more concurrent or risk-based auditing to improve effectiveness.
So the AG is the independent watchdog. Our sources mention PFA pillars. What's PFA, and what are these pillars?
PFA, public expenditure and financial accountability, is a global framework used to assess how well a country's PFM systems are performing. It helps identify areas for improvement.
And it uses pillars.
Yes, 7 core pillars covering the key aspects of PFM. They are budget reliability, transparency of public funds, management of assets and liabilities, policy-based fiscal strategy and budgeting, predictability and control in budget execution, accounting and reporting, and finally, external audit and scrutiny.
How does PFA use these pillars in an assessment?
Within each pillar, PFA has specific indicators, currently 31 of them, that measure performance. By assessing a country against these standardized indicators, PFA gives a comprehensive snapshot of PFM's strengths and weaknesses.
And links it to outcomes.
Right. It relates the assessment to those key goals: aggregate fiscal discipline, strategic resource allocation, and efficient service delivery. It's a detailed, evidence-based health check for public finances.
Sounds like a very useful diagnostic tool. Based on assessments like PFA and government priorities, what are the main PFM reform strategy areas identified in Nepal?
Several key reform areas stand out. There's policy reform, improving the legal environment, strengthening the actual legal framework for public finance. Budget reforms, better preparation, execution, monitoring.
What about planning and accounting?
Yes, reforms and public expenditure, planning to align spending with priorities better. Accounting reforms, like implementing NPSAS to improve reporting quality, strengthening both internal and external audit.
And systems integration.
Definitely. Moving towards more integrated PFM systems, linking planning, budgeting, accounting, reporting. And finally, building professional capacity training for accountants and auditors in the public sector. It's a multifaceted approach.
A comprehensive set of areas. What's the overarching Government of Nepal GON focus right now in driving PFM reform?
The GON is strongly focused on continuing reforms to improve both the efficiency and the effectiveness of PFM across the entire budget cycle.
So end-to-end improvement.
Yes, from revenue generation through planning, budgeting, execution, accounting, reporting, right up to external control and accountability. The main goal is making the whole system more predictable, transparent, and accountable to the people.
With the new federal structure, how does financial management in subnational government, provinces, and local levels work?
Nepal now has 3 tiers: federal, provincial, state, and local. Each has its own constitutionally defined financial resources, taxes, fees, commercial revenue, royalties, plus loans and grants, often transfers from the federal level.
And their financial processes.
Generally similar steps at each level: budget presentation and approval by their assemblies, budget execution and control, recording and reporting, increasingly using NPSAS, monitoring and evaluation, internal and final audits, and scrutiny by their own public accounts committees or equivalent bodies. The specifics are still evolving as federalism beds in.
Let's dig into the budget formulation process in Nepal. What are the main stages?
It typically follows 4 major steps. First is forecasting. A resource committee, often led by NPC, projects macroeconomics and estimates resources and spending needs.
Then setting limits.
Step 2 is ceiling setting. A budget committee, NPCMOF, sets overall spending limits for sectors and ministries based on resources and priorities. They also issue guidelines for budget prep.
And the detailed planning.
Step 3 is budget planning. Line ministries prepare their detailed program and budget requests based on the guidelines and ceilings. Then there's negotiation and finalization with MOF and NPC.
Finally, approval.
Step 4 is budget approval. The government presents the budget to Parliament around just the 15th for discussion and final approval. It's a mix of top-down guidance and bottom-up proposals.
Seems well defined, at least on paper. Looking back, what were some problems of PFM and budgetary policies of the 90s in Nepal and initiatives taken to fix them? Understanding the history helps.
The 90s saw policies focused on liberalization, privatization, poverty reduction, and early decentralization. But PFM tended to prioritize control over strategic allocation.
Leading to issues.
Yes, a widening resource gap due to poor domestic revenue collection meant heavy reliance on foreign aid and deficit financing. Planning, budgeting, and implementation were often weak due to capacity issues and poor coordination.
What initiatives were taken in response?
The GON started several initiatives over time: financial administration reform programs, projects to strengthen PFM systems, adopting GFS-based codes for budgeting, rolling out the Treasury Single Account, TSA, developing strategies for adopting standards like NTSAS, participating in PFA assessments, and various capacity-building programs, all aimed at improving governance and accountability.
Insightful to see how past challenges shape current reforms. What are some of the main achievements of the PFM reform program in Nepal more recently?
There's been definite progress. The second PFA assessment showed improvements, likely due to first-gen reforms like better budget credibility, tax policy work, the TSA rollout, and FMIS improvements.
The TSA rollout was significant.
Hugely significant. It's now nationwide, covering all budget execution, consolidating numerous bank accounts, and monthly online budget execution reports have boosted transparency.
What about financial reporting and audit?
Big efforts there. NPSAS was piloted successfully in ministries, even getting international conformance certificates. The OAG has strengthened performance audit capacity and adopted more risk-based approaches.
Other key achievements.
The Line Ministry Budget Information System, LMBIS, improved budget links, tax and customs reforms using IT, PAN numbers, online submissions, MTEF implementation by NPC for more policy-based budgeting, a new Public Procurement Act and e-procurement system aimed at efficiency and transparency, often done with support from development partners.
That's a solid list of achievements. Now, while our focus is NPSAS PFM, the sources mention challenges to implement NFRS in Nepal. NFRS is different, private sector FRS-based, but could the challenges offer broader lessons for implementing any new accounting standard in Nepal?
That's a fair point. While NFRS and MPSAS differ, the types of challenges faced with NFRS can be indicative. Things like lack of awareness and education about the standards among users and preparers.
Capacity issues.
Definitely. Insufficient capacity building and training for professionals. Also, inadequate IT infrastructure to handle more complex data and reporting needs.
What about adapting the standards?
Difficulties in interpreting and adapting international standards to the specific Nepalese context, legal, regulatory, business environment. Needing a strong, consistently enforced regulatory framework is another challenge.
And for smaller entities.
Specific challenges for SMEs, like implementation costs and getting all stakeholders aligned. These highlight the need for thorough planning, engagement, resources for training in tech, and regulatory backing whenever introducing major accounting changes, public or private sector.
Those are indeed big hurdles.
Yeah.
Back to NPSAS specifically, what initiatives taken by GIAN to strengthen the PFM system relate directly to adopting and implementing NPSAS?
The GIAN has shown clear commitment here. There was consensus on adopting cash-basis IPSAS as the foundation for NPSAS. The government actively participated in developing NPSAS.
And implementation.
Regulations were amended to mandate NPSAS use. Successful pilots in key ministries were crucial. Getting those certificates of conformance really helped build momentum.
Was it rolled out more widely then?
Yes, a phased rollout followed, eventually covering all central-level economic entities for whole-of-government reporting by 2018. The OAG also approved NPSAS-based reporting formats for all three government levels, and efforts continue to support implementation at provincial and local levels as federalism matures. It shows a sustained push for standardization.
A strong, deliberate effort. Our sources also mention a second-phase PFM reform strategy. What were its main aims and expected outcomes?
Right. PFMRP Phase 2 aimed to build on Phase I progress and address findings from later PIFA assessments. The goal was deeper, more sustainable improvements, better fiscal discipline, budget execution, capital spending management, revenue mobilization, and more accountability and transparency.
How was this broken down?
Into 8 specific expected outcomes, closely tied to PIFA indicators. Things like improved budget credibility, more comprehensive and transparent budgets, better policy-based budgeting linking spending to priorities, more predictable and controlled budget execution, improved accounting and reporting, including full NPSAS implementation, stronger external audit and scrutiny, better HR management and PFM capacity, and aligning donor practices better with Nepal's systems.
So deepening the initial reforms and making them stick.
Exactly. Focusing on sustainability and tackling persistent performance gaps identified by PIFA and other diagnostics.
What were some challenges for implementation in second phase reform and the immediate prioritized reform actions identified?
Further strengthening PFM was seen as crucial. Out of many action plans, some were tagged as immediate priorities needing quick action with high potential impact.
Can you give some examples?
Things like a new comprehensive budget management and financial responsibility law, better harmonizing and connecting different FMIS systems, setting more realistic spending limits during budget prep, improving revenue forecasting, better tracking of commitments and spending, upgrading cash planning and its link to the TSA.
More systemic changes.
Yes, also promoting a unified nationwide financial system with trained staff, empowering sector ministries more in execution, multi-year local budgeting and financial codes, updating systems for the new federal structure, a specialized PFM training institute, improving the final audit process, upgrading the government accounting system, GAS, and a comprehensive government accounting manual.
What was the overall approach?
A staged approach. Build strong foundations first, then move to advanced techniques, recognizing Nepal's strengths in formal rules but weaker functional implementation. Focus on enhancing existing systems, government ownership, and context-specific solutions.
A detailed strategic action plan. Finally, could you give us the key highlights of Nepal Public Financial Management Reform Strategies Program Phase 2?
PFMRP2 built directly on phase-on and PIFA findings, which was a GEON self-assessment. PIFA had shown improvements in budget credibility, comprehensiveness, accounting reporting, audits, but also areas needing work like execution, parliamentary scrutiny, extra budgetary funds.
What role did IT and sustainability play?
IT was seen as a key enabler of progress. Sustainability was a central theme. The new federal structure was seen as both a challenge and an opportunity for PFM enhancement.
How many action plans were there?
The strategy outlined 119 action plans overall, but strategically focused on immediate priorities, initially 23, to be integrated into short, medium, and long-term strategies led by a national PFM steering committee.
What were the guiding principles?
Three main ones: broad stakeholder consultation, learning from Phase I and acknowledging capacity limits, and prioritizing government-executed projects for ownership and sustainability. It really reaffirmed GEON's commitment to sound PFM for good governance and development.
Wow, this has been an incredibly thorough deep dive into PFM and NPSAS in Nepal. We've covered so much, from the nitty-gritty of accounting standards to the big picture reform strategies. It's clearly such a vital area.
Absolutely. Understanding these concepts, the NPSAS principles, the PFM cycle, the reforms, the challenges, it's all crucial for anyone wanting to grasp how public resources are managed and how Nepal is striving for greater accountability and transparency.
And that brings us to our final thought for you, our listener. Given all these ongoing reforms and the sheer complexity of Nepal's federal system, what do you think is the single most critical factor for ensuring truly effective, sustainable public financial management in Nepal moving forward?
Is it about stronger laws, better technology, more investment in people and skills,
Yeah.
greater citizen oversight, or maybe something else entirely?
Definitely something to ponder. We encourage you to reflect on that, maybe revisit some points from today's discussion. Thanks for joining us on this deep dive.